Welcome to the show, Jason, Rob.
So we're talking about syndications and funds and when things go sideways.
You know, I've noticed Facebook is really quiet these days.
Quiet, yeah.
I'm seeing a lot.
Not for us, but for everyone else, right?
I'm seeing a lot fewer private jets and Lamborghinis. I don't know what happened. Where'd all our syndicators go? There was a whole lot of syndicators where Lamborghinis, private jets, crazy vacations.
Well, I mean, we're part of that group too.
I mean, we are. But, you know, it is funny. I had one of our investors. He's like, hey, you know, we did the capital call on one of our deals. And he goes, you know, Jason, I'm still seeing the Lamborghinis and all that. I'm like, and vacations. I'm like, yeah, but I'm flying Southwest. I mean,
yeah,
with points. Like,
right.
I'm not flying in the G6. Like, so.
Well, that's that sort of thing, right? They can't separate the two, right?
Yep.
But we had another issue. It's like, you know, I don't own that. The LLC owns that.
Right.
You understand that? You understand it's not my deal. I'm the sponsor of the deal, right?
You know, that's a real interesting point. Let's talk about syndications real quick.
Yep.
This is not Jason's syndication. That's not how that works.
It's not your deal.
This is a group of general partners got together and said, this is a good deal.
Yep.
Based off what we know.
Sure.
Those documents were then created and sent to the LPs. And the LPs all agreed, hey, this looks like a pretty good, knowing what we know, this looks like a pretty good deal.
Sure.
Based off of our experience as investors, right? Because they're sophisticated and there's accredited investors. Yep. So based off our experience, we believe it's a pretty good deal. So let's all chip in a couple of bucks and go for it and go do the deal. But I always notice whenever a deal has challenges, like, oh, that's Jason and Rob's deal. Well,
Jason's driving in a Lamborghini, you know, so I don't know what's really going on there.
I don't know what's really going on here.
Yeah.
I'm not getting the information I need.
Are you worried about what they'll say about you? I don't care.
I don't. It doesn't really bother me. So I kind of got over that in high school. That's one thing you kind of want to get over that one.
For sure, me too. Yeah.
But I was joking with one of our GPs probably 2 or 3 months ago. And we were having challenges in one of our syndications, which we've shared with everybody, construction related, right? And so I was joking with him. I said,
Still having them,
right? Yep. Yeah. Until it's done, we will still have them. And so one of the comments I made to him is I said, you know what's going to happen, right? He goes, what's that? I said, there's all this belly aching and heartache and this sucks and in the middle of the deal. And I said, when we sell this thing and we've doubled the value of it, like getting 5x our money back.
Yeah.
You're all going to sit here while we're eating steaks and smoking cigars and drinking whiskey, and everyone's going to say, let's go do it again. And then I'm not going to forget this time, right? I'm not going to forget all your emails and phone calls.
No.
Yeah,
yes,
I'm like, no. I will tell you right now, here is where we are at in the business cycle. If you guys go back and watch The Big Short, Michael Burry built a fund. This is how he made all that money. And he would get email. There's a scene in the movie where he gets emails daily. What are you doing? You're a moron. You're losing my money. I'm going to sue you. All that stuff. And he just had to sit there, quietly take it.
Yep.
And then when he made his money, he gave all his investors money back, plus their huge returns.
489%.
Yeah, 500% in like 10 minutes.
Yep.
And then they all came back to him and said, let's do another one. He's like, I ain't doing that again.
Yeah, nothing.
It's not worth it. Then he built a family office and he just like real close friends and his money. But that's where I almost feel like it's these hard times where you get all these nasty emails and you're like, I'm not doing this again.
Well, he wrote the email and he said, at this point, we cannot do any further distributions. And it's like,
yeah.
What do you mean? What do you mean? It's
yeah.
Yeah. Hey, we gotta be healthy here, right?
Yeah. Yep.
So yeah, well, I mean, that's the difference between active and passive, right?
Right.
And I always describe it this. It's like, hey, if someone's telling you 10, 12, 13%, that's pretty high risk.
Oh, I will tell you, I was at the Alt Asset Conference this weekend.
Yeah.
So I spoke at the Alt Asset Conference. Big thanks to the team there invited me out. The Alt Asset Conference was fantastic. About half of real estate investors, half was like everything else. Private placements, angel investing, direct placement, like big
family
money stuff, right?
Funds, yeah.
All kinds of stuff. So I got to hang out with a lot of folks. And it was a really great family office that gave a presentation. He said, look, here's the deal. We're probably about 15% rate of return. When you break it all down, 15% per annum. And you get much higher than that, and this guy's hundreds of millions of dollars that he manages. And he said, you get much higher than that, it starts to trip some red flags for a passive investor. So he said, look, if you should be, he was talking about lockup periods and everything else.
Yep.
He said, your fund manager should be performing at about 15%, maybe as low as 10. If it gets much higher than 15, 17, 18, you really want to kind of start looking at some things that might be too good to be true. But he said, you should be around 10 to 15%. And I thought, you know what, Here are professional money managers full of a room.
I've always said 12.
Yeah.
12 is a good number.
12 is a good number after fees.
With risk.
Yeah, it's all risky.
That's the risk stuff, right?
Right.
I'm saying, hey, 12 is high risk.
Yeah.
Low risk right now is 4%, right?
Right.
T-bill.
Well, and I pointed out, it was funny, the guys that went, I think it was the Bradley group that went before me, and they flashed up this slide of like what groups like them are investing in. And I saw it and I said, oh, that's the commercial real estate crash right there. And I told the guy, their AV guy, I said, grab that slide for me from their presentation. I'm going to use it in my next presentation. He said, okay, cool. Just give me the signal and I'll throw it up on the screen. It's perfect. So I get up on stage and I'm like, hey, did you guys see the real estate crash in that one? And everyone's like, what? The room was silent at that point. They just did this great introduction for me, and I got up on stage. I was like, did you guys just see the commercial real estate crash? And they were like, wait, I thought you were supposed to talk about AI and finding deals. I'm like, I'll get to that. I'm like, and the guy's name was Jason, I think. So I'm like, hey, man, can you throw that up on the screen? So he puts it up there, and you can see it was a bar chart for the last like 7 years. And you can see the difference of how much capital has gone into commercial real estate last year compared to this year.
So they're showing their diversification year over year.
Right. Well, this is the industry as a whole. It wasn't just them. It was a whole, right? And so this is like family office, angel investing, all that. What's the total amount of capital by asset type?
Gotcha.
So one of it could be like crypto and gold and equity. Like it just kind of had whatever the categories were. And real estate was a pretty significant one.
Yeah.
But if you look at year over year change, it's like a 2/3 drop in funding. And I'm like, that's what the beginning of the crash looks like. And everyone's like, okay, why? I said, because all the investors are getting out and the money is drying up.
Right.
This is why Pier Street had to file for bankruptcy last week.
Yep.
And they said in their bankruptcy filing, now remember, let's go back to Michael Burry. By the way, Michael Burry is an investor in that. He started in 2015. So these are not dumb guys. These are sharp guys.
Really good guys.
Killers, right?
Mm-hmm.
And so these guys in their filing basically said there is not enough private capital. Like the equity markets, the capital markets have dried up. We can't get new equity. And the debt markets are all but dead. So he basically said, all right, game's over, filing bankruptcy. You know, they fired 90% of their employees.
Went from 300 to 30.
Yeah, like in like a quarter, right?
Well,
so,
but you know what? That's a guy who's professional and said, market's not supporting me. It's not my deal.
Yeah.
Right? I'm out.
Now, does everybody run around and say that CEO failed? And he's no.
But you know, but the real people that understand it know that, hey, the market turned and that was it, right?
That's
again, I'd rather be out in front of it, right? And just talk about we're talking now than to sort of like hide it and, you know, non-disclosures and hey, I get it. You know,
market fell apart.
Market fell apart. And that was our last show. It's like, what you've been waiting for.
Yeah.
And crash this year. So what are you going to do?
Yeah, so let's talk about what a failed syndication looks like. No one talks about this. Everyone talks about how much money. This was fascinating. So there were a bunch of syndication guys in there, right?
I'm sure. Yeah.
So I went to a happy hour and then we went to dinner and just having a lot of conversations. And I said, look, if you're looking at your syndications right now and you're not talking about capital calls, someone's hiding something.
Right.
So there should be at least on the periphery, some conversation about capital calls. And they said, well, you know, do you do syndications? I'm like, yeah, I got 2 funds and 5 syndications. And I said, here's the deal. Insurance is way up. Taxes are way up. So is the cost of construction. So your make-ready expenses, your turns are more expensive.
Right.
So even if you're not having a capital call, you ought to be having a lot of conversations about cash flow. Your cash flow has come down in the last 12 months. And if it hasn't, I'd really start asking a lot of questions.
Right.
So, yeah. So I'm scaring everybody in the room.
Which is just on the top. You flip everything on the top of your head, right? Because most people would be like, hey, I got no cash coming in. There's something wrong. It's like, yes, there is something wrong. And I'm sure they have it in their documents. I'm sure they're going to talk to you about it. Versus, no, I'm still getting paid. I'm like, well, how's that happening, right?
Yeah. Why did it? Yeah, I'm still getting paid. Well, what are you getting paid out of? The reserves?
The reserves. We eat the reserves.
What are you getting paid from?
Dumbasses like us that lend to the funds and stuff. Right?
Yeah. So I would go back and say, okay, well, let's talk about what happens when syndication fails. So syndication's having some challenges, and it's always related around cash flow and reserves. It's that simple.
Mm-hmm.
So you run out of reserves, you hit up all the investors syndication. Hey guys, we got to have a capital call. Vote on it. These all end in the same place. Whether the capital call gets voted down or the capital call gets voted for, and they don't raise them enough money, it all ends at the same place, and that is liquidation.
Mm-hmm.
So what happens in a liquidation event? Well, it's a couple of ways. It could be a forced liquidation, like the $300 million deal that fell apart here in Houston. Bank went in and foreclosed, wiped all the equity investors out.
Right.
Now, when they take that property auction, if there's any additional proceeds, then they'll send it back to the syndication. But how most deals work is the first person that gets paid. So we've got to liquidate this thing, whether it's a fire sale or a foreclosure, which is technically a fire sale. First person that gets paid is the bank.
Yep.
First lien position, they get paid first.
Sure.
The second is the construction company.
Take a step back.
Okay.
If we're getting foreclosed, the bank takes over.
Oh yeah, they take.
You don't get to set the price, the sales price.
No, they take it to auction.
They'll take it to auction, and they just want their money out.
Yeah, they're taking it to auction.
Yep.
So, this and some of these deals get so big, who else is going to buy it, right? Like it's pretty tough. So, all right. So first lien position, that's your bank gets paid first. The second one's a construction company. So when I was talking about that $300 million deal here in Houston, there's a guy that owns a construction company and said they owe us $2.5 million.
1.2.
Or $1.2 million on construction.
Right.
He's going to get paid second.
Yep.
So construction gets paid second. And
if it's there.
If it's not there, okay, then you go to the next one. The next one is what I love. Catherine puts it this way. This is the legal term. Loans from managers and affiliates.
Yes.
So everyone's like, well, what does that mean? Really, it means your general partners.
Right.
So if you're having some challenges and it takes 30 days to raise the money from the capital to vote on the capital call, another 30, depending on how your operating agreement's written, then another 30 days to get the cash in. You got a 60 days of carry where your reserves are already relatively depleted.
Yep.
So now you've got the managers, which is really the general partners, are lending back to these syndications.
Right.
Now, here's where it gets funny. A lot of folks will say, wow, well, that's kind of a good deal if you're a general partner. I'm like, no, it's not, because in the operating agreement, I'm not buying any more equity. I'm putting in debt, and that debt pays me like 10 to 12%.
Right, 10%.
Which is not stellar, right?
Nope.
So now you've got loans from managers and affiliates.
Because that debt can hang out there forever. It's not a good deal.
The debt could stay there forever until you refinance.
Yep.
Anyway, so then the next folks that get paid their money back, not their, remember, we're just talking about paying the principal, not paying their paid-in capital back, are the limited partners.
Sure.
So limited partners get their money back. GPs get their money back, general partners. And then there's this line, and that line is profitability. Well, who gets paid first if it's profitable? Below that line, it's going to be whatever your documents say. And most of the time, it's the LPs get paid first through a pref, right? So there's a preferred return. That goes back to the LPs. Then the GPs finally get paid after that. So I have heard investors say, well, I'm an investor in this deal, having all these capital calls and these other problems, but, I'm going to get made whole. And I'm like, no, you're not.
No.
Like, what's happening is the managers and affiliates are lending back to keep this deal afloat, and they're putting their money ahead of yours. That's all in your operating agreement. Like, this is not like some spooky Jason, where did you hear this from? Internet guru. It's
you
like,
must be wrong. Yeah.
Yeah. Look, call your attorney, call your securities attorney and ask them how it works.
Right.
So what ends up happening is the managers and affiliates, which is really the general partners, and it could be some other the GPs can go out and raise fresh debt just to keep the deal afloat. And that's going to put your...
And preferred debt too.
Yeah. And preferred. That's right.
Yep.
And that puts the priority of getting paid down to the very end.
Pushing all the way down. Yep.
So we've had a lot of conversations with our attorneys, like, okay, so if there's a failing syndication, how do we go in there and rescue it? And he said, have you ever heard of a vulture fund?
I like the other one.
White Knight.
White Knight fund.
Yeah.
Yes.
We can call it White Knight. I kind of like vulture. It's like, imagine it's this like
White
ugly
Knight
vulture,
fund,
bald head, ready to take over. But anyways, you could actually develop a fund that goes in and rescues syndications.
Sure.
So you use your capital, your fund's capital, and you put it right behind that first lien.
It's not just it's not just the capital. The tip of that spear is going to be the negotiator.
Right. Oh, absolutely.
To negotiate that first lien, right?
Absolutely.
Otherwise, you wouldn't put your money in if it's exposed.
Right. So the conversations we're having with some folks, some lenders right now, is how flexible are you at changing terms?
Yeah.
And then we could essentially back into, okay, we know this syndication is using this bank. So, okay, we are willing to put our dollars in, provided we can take care of these terms. It's not the amount of financing. I think that's where people get confused. It's like, well, they paid too much for it. I'm like, no, it's because it's all due right now.
Yep.
Like, we can always move this around a little bit and save the deal. So in any case, the good thing is there's opportunity here. But the bad thing is that there are going to be capital calls. They're all coming on all these syndications. And that's what happens when they go bad. That's that order of liquidation. So
I would just tell you, for us, we want to go first.
Oh, absolutely.
We're running to this stuff.
Yeah.
Let's see where we're at, and let's see what we need,
Yeah.
and make sure we have 18 months of reserves.
Yeah.
And if we don't have reserves, then the capital call needs to come in from reserves and some other things, right?
Yeah.
Because we know the next 18 months are going to be rough.
It's going to be a little bumpy in the financing market. And that's the real challenge. It's the financing side. It's not, the deals could be doing really well. When I was a member at a club here in town, I met a guy, him and his partner. I just met one of the partners. They had about 1,100 units in Dallas, Fort Worth. And they were B. He said, we bought them as Bs, brought them to like a B plus. And he said, Jason, they were printing money. We got them for a stellar deal. They're printing money.
Yeah.
And he said, here was the problem. They came up for refi on our 5-year balloon in the middle of 2008. There's no credit. There is nothing. And he said the banks happily took that one back.
Yeah.
Because it made so much freaking money. So,
and that's what's going on today.
That is what's going on today. But I think what you're going to see something a little bit different in that banks are not going to want to take these back as long as the borrowers are playing ball, because the banks cannot afford to have bad debt on their books.
Yeah. Especially
over the last couple months. So I think you're going to see a lot of negotiating, and some of these deals are never going to, unless it's the worst deals are not going to make it on the market.
I think the ones that were bought at, I don't think we're ever getting back to 3.5% interest rate on commercial properties.
I don't know. We'll see. It'll be.
I don't think in the next 5 to 7 years.
I don't know. Maybe.
That's what our other partner said, is just go ahead and change the 3.5% to 5% and watch your pro forma explode.
Oh, yeah.
Right? Just watch it disintegrate.
Yeah.
So anyway, that's what happens when those deals go bad, when those syndications are going sideways. So you're going to be hearing about this for the next 18 months.
At least 18 to 24 months. The gurus gurus will start teaching vulture funds 24 months from now when it's already over.
When it's all over.
It's like already over. And they're like, you could buy a syndication for pennies on the dollar. Come to my class. And it was like, hey, bro, it was 2 years ago. You should have been listening to the show like everybody else does, right? It's like, no, you should have been listening 24 months ago.
Oh, that's funny. All right. Hey, thanks, guys.